Welcome to Real Estate Radio Live, an informative and engaging podcast discussing everything you need to know about the world of real estate. Your host, Joe Kuchera, provides you with insight and guidance on how to buy, sell, finance, and invest in real estate. He also offers real estate tax management strategies, new construction advice, home improvement tips, and much, much more. And now, to guide you around the world of real estate, here's your host and Real Estate Radio Live team leader, Joe Kuchera.
Welcome in. Good afternoon. Joe Kuchera with Real Estate Radio Live. I guess it's this morning. Got to get used to these morning shows, not so early. Anyway, Joe Kuchera with Real Estate Radio Live. Thank you for those that are following us live feed on Facebook. We appreciate that. For your convenience and for planning purposes, if you do want to follow the show on the social media side, every single Monday, unless we have plans that change, we plan to do the Home Wealth Series with the gentleman at Bearstone, Steve Hotovec, and also Mark Rogers, who is not with us today. We'll rotate, and we'll do those every Monday at around 11 o'clock Pacific Standard Time for those that want to check in and follow the show. Again, we'll typically do the afternoon shows Tuesday, Wednesday, Thursday, right around 3 o'clock, depending on our schedule. However, the best way to do that, of course, everybody's busy doing things and busy lives, so be sure to download the podcast. That way you get the show, listen to it at your convenience, anywhere, anytime that works for you. You can get that podcast anywhere, the normal places. You could go to iTunes, type in Real Estate Radio Live, Google+, Stitcher, go to our website, reradiolive.com, and you could download the podcast there. We continue to grow the show. We want to continue to add as many opportunities to do that. So please pass the information along to your friends, family, coworkers. I got a couple of great emails this morning of people that said they've been following the show for 3 years, and we always get some great feedback. And we also love any ideas. A gal today, Steve, gave me an email and said, love following the show. Maybe you guys, have you ever thought about doing multicultural things? There's a lot of lending going on with Hispanics buying home and that type of thing. It was a good point. Yeah. So a lot of good topics to share, and we'll continue to do that. For more information, you go to reradiolive.com. All right, let's jump in again every Monday, our Home Wealth Series with Steve Hotovec. He's with us today with Bearstone. Good to have you back.
Thanks, Joe.
Steve.
Always a pleasure.
Yeah,
it's great.
Good.
Got an extra hour of sleep.
That's right. I forgot about that. And so, again, the focus, we're excited about this program. We just kicked it off about 3 weeks ago, I think, and we'll continue to bring it to you every single Monday. The reason why, most of you know, I've been doing this for almost 8 years, and the reason why we're going to have a focus on this topic and this really important opportunity for people is because anytime something comes to the market real estate related that I think is of value to you, the consumer, you will be sure that I will bring it to your attention, educate you, and inform you about it. And this is definitely a product that we intend to educate people over the next several months and the next several years because it presents a great opportunity. So we'll continue to talk about it. Again, it's the Home Wealth Series every Monday with Steve and Mark with Bearstone. So why don't we could just do, Steve, if you give the listeners another reminder, maybe quickly about your background, and then Bearstone, how you guys got started, and then we could talk about our topic today.
Sure.
Yeah.
Our background is, I always like to say, it's not from a great insight. It's painful experience. But
those are the best.
But it basically has a finance and investment background, both Mark and myself. Mark in private equity, me in securities, hedge funds, alternative asset classes. And we got involved with, and always looking at sort of pushing the envelope, looking at, it began probably in 2005 when we began looking at alternative asset classes or absolute return vehicles.
Okay.
What that is in layman's term is basically rather than having a benchmark such as the S&P, absolute return says what type of a return did you get in relation to the risk that you took.
Got it.
So, for example, in the stock market, you can have big rises and declines, and they call that, peak to trough, right? Well, you get the same sort of thing in real estate. So after we sort of migrated, we started looking at different asset classes, and actually the largest asset class, and we've said this before, and a lot of these things as we go through this is repeating.
Right.
The largest asset class in the world is residential real estate. And so bringing it into the United States, you're looking at real estate, there's approximately $15 trillion of trapped equity. And it comprises most Americans that are homeowners. If you're a homeowner, chances are, and we're going to get to the Bay Area in a minute, but in the United States, you have about 60% of your net worth trapped in your home's wealth. And the Bay Area, it can be as high as 70 or 80%. So the problem with that is most Americans, homeowners, are house rich and cash poor.
Right.
The home is an illiquid asset, as we've talked about before, so you can't really access it without either taking on the burden of debt or selling it.
Right.
And so there are new products out there that are future price agreements, home price movement agreements that we began working with in 2014. And there's been a lot of development. They're a very powerful tool if used properly.
Right.
And this is really just getting the word out of tools, solutions, and strategies that can incorporate non-debt liquidity solutions.
Okay,
so
very good.
That's our background and how we got involved in this.
Yeah, so this would be, again, if you're listening to the show, watching the show, whether yourself, maybe parents, grandparents, aunts, uncles, it really doesn't matter. Someone wants to access equity from their home. There's several ways to do it. And I think it's always a good idea, Steve. Why don't we go through that, too? Let's just kind of go through, I think repetition and education is a big piece of this. You know, maybe you could just take us through the different options one has to access equity for the home. Which ones are liabilities in terms of debt and monthly payments, and which ones are not?
Sure. So let's go through the list of usual suspects.
Right.
So you have a credit line, right? With obviously, I'm not telling you anything you don't know on. So a line of credit. That could be a second mortgage. You have a HELOC, which is a little bit different, but same variety. So those are debt vehicles. And those vehicles, a lot of times on a home equity line of credit, you may draw on it for, a period of 10 years, or it'll recast, right? So they'll draw it. And a lot of folks did that back in the last housing bubble and said, and standards were a lot looser then than they are now, as you know. And then the last is, so you've got a mortgage, you've got a line of credit, either a first, second, or a HELOC, and then you've got a reverse mortgage. So a reverse mortgage is just a mortgage that goes in reverse. So you actually start drawing it out, and it compounds over time.
Right.
The other way that you can get liquidity is you can sell your house, but that's an all or nothing proposition.
Tax implications, all kinds of different things.
Especially here. And so to put it in perspective, here in the Bay Area, last week there's an index called the Kay Shiller Index, and actually Mark was on Monday, and the report comes out I think it's the last Tuesday of each month. And the Kay Shiller Index, just to explain to listeners what that is, it is an index that measures repeat sales of homes. And it's broken into MSAs, which basically stands for Metropolitan Statistical Areas. So an MSA for San Francisco has 5 or 6 of these localities. There's Contra Costa County, Alameda County, Marin,
Santa Clara, Alameda, Contra Costa.
Santa Clara's a different one. I think. But anyway, it's a 5-county. It gets a big swath. And so it's all homes that have been sold, not new homes that have been sold. And so that index, and I scribbled down a couple notes here. So in 2012, 6 years ago, the index was at 143. The index last Tuesday reported at 269.
So, wow. What does that mean?
That's an 88% increase, in 6 years.
Wow.
And if you look at the 7-year number, the number was at 129, and once again it's at 269. That's 107%.
Wow.
So in 7 years, homeowners, just the average homeowner, has seen a rise in their home wealth by 107%.
Yeah. And think about that. Let that settle in. And go do a little research yourself, too. Kay Shiller. Go to kayshiller.com. And as Steve said, it's really one of the best places to get updated information on housing and understanding it a little bit. But it is really, really good. So educate yourself on that. But that's an incredible amount of growth. The last thing, I shouldn't say not the last, but the other thing I wanted to add to the different options, Steve, was, and I'm having conversations with clients right now as I do. My primary business is residential mortgage. Most of you know that follow the show. Is that one thing that's surprising people about the home equity lines of credit right now is what? The Fed is continuing to raise the prime, and it sounds like that'll continue, maybe another 3 or 4 times, depending. So what's happening is that rate is continuing to go up. If we all remember the good old days for, years, right? The Fed not only lowered, it was almost nothing.
Right.
So those home equity lines were like, wow, this is great. I got a $300,000 home equity line. My payment's, $120 a month.
Right.
Those times have changed.
Well, we would have people say to us, why would I actually do a home price movement? And just to reiterate what those do, they basically allow you to access a portion of your home's wealth, usually up to 20% of the home's value, in exchange for sharing in the future, a percentage of future appreciation. That percentage of sharing is going to depend on how much you access in the beginning. But it normally will be anywhere from, say, on a 10%, you may be sharing 30 to 40% of the future appreciation.
Equity.
Now, if you look at investments and diversification and income, and you look at as your equity grows and you're paying down your mortgage, or you're either retirement or pre-retirement, you pretty much have it up to your eyeballs in all the equity you need. And you've seen an incredible return. And so oftentimes we would talk to people and they'd say, well, why would I actually do that? And then other people would say, well, why would I not do that? And so somewhere in between, but it comes down to balance, okay? You can't have all your eggs in one basket, and more people are now looking at shifting gears and moving from converting accumulated wealth in the home into generating income. Right.
So one of the things that I would say, I like to break things down in common sense. I'm a big fan of common sense and make things really easy to understand. So I would say if you're listening to this podcast, again, yourself, someone, pass it along. If you're one of these people that are kind of in the following situation, you have owned a home or been in a home for, 10 plus years, and you have a lot of equity, 5, 6, 700,000, million plus in equity. And on the other side, most of the time this is the result of the older generation, but not always. But on the other hand, you look at your balance sheets, so to speak, and you have very little income coming in. People that are retired, maybe Social Security only. Some people weren't fortunate enough to have pensions, and those things have gone way by the wayside, very few people. So what we see a lot, if you are a person that fits that criteria, a lot of equity in your home, and you're kind of looking around and you're trying to figure out, how am I going to do this? How am I going to stay here? What am I going to be able to do if I'm on a limited income each month, but yet I have all this equity? What do I do? And I think, this is the message that we'll continue to try to get out. It's an educational process, Steve. It really is, because it's like anything else. When there's something new and it's available to people, we're creatures of habit, right? If we're used to listening to the same thing over and over and over and over again. But this is an exciting opportunity for people, and I see it every day. I know you do. I give examples, and I think examples are good. I was with a lady a couple of weeks ago. This was kind of the perfect scenario. She's 78 years old. Her home's worth a little over $1 million. She owes maybe 100 or so thousand on it. And she's a couple things. She's still working part-time because all she has is Social Security.
Sure.
And, she doesn't really want to work part-time, but she's doing it because she has to. She's very responsible. And she's renting a room to offset because she has nothing but Social Security, and she worked her entire life. And the last thing is, she thought it would be a wonderful gift to her son and her daughter-in-law to, gift them $100,000 to help them buy a house. So a program like this would be perfect for her.
Sure.
Yeah.
We have a lot of clients that it starts with, what is this thing?
Yeah, right.
And we usually always start with, well, here's the problem. But you actually aren't poor. You have quite a bit of assets. You just have it in an illiquid fashion. Yeah. And you spend all this time paying off the mortgage. You really don't. And the reverse mortgage has its place.
Yeah,
it certainly does. But it depends on the situation. So what we normally will do is stack up all the options with future price agreements or home price movement agreements. They can work in conjunction with debt. Okay. So, for example, someone may have a mortgage at a low rate, or even at a rate now, which historically is not, everybody's like, oh, it's so high. So they forgot about the 70s and the 80s, right? But they can use this tool to pay off credit card debt, to pay off a HELOC, or just have it as cash. Okay. So if someone has a $1 million home and they have $200,000 in savings, let's say, and they were able to access $200,000, without taking on debt. They still have the equity that they have in their home, and they've doubled their savings. Yeah. They've now gone from $200,000. They've had a 100% one-time increase in liquid. That gives tremendous peace of mind,
that does.
which is the number one reason that folks do this.
Yeah, absolutely. All right, here's what we're going to do, as we always do, about halfway through. The shows usually go about 30, 35 minutes. We're going to take a quick break. For those that are watching us on Facebook, stick with us. It's just 1 minute quick break for our podcast. I'm sitting here in studio with Steve Hotovec with Bearstone. We're talking about home wealth. This is our home wealth series, and we're talking today about, again, educating people how you could access some of this. We'll be back with you to continue in just a minute.
For more information on today's program, visit RERadiolive.com. That's RERadiolive.com.
How would you like the opportunity to secure a record low interest rate while buying and or selling your home? In addition, how would you like to save 20% or more on your entire real estate transaction? Finally, how would you like to bundle all your real estate services in one location? Well, now you can achieve this with BundleSelect.com. That's right, save on real estate lending and title. With BundleSelect.com, technology and a personal concierge are at your service to save you time and money. BundleSelect's hand-picked team of experts will save you thousands of dollars by bundling real estate lending and title services. BundleSelect.com gives you all the control, including using your own realtor. I'm Joe Kuchera with Real Estate Radio Live, and I have been on the radio educating consumers for years. I'm here to tell you BundleSelect.com is the best way to save money on real estate. By bundling services, you could save tens of thousands of dollars. Visit BundleSelect.com.
The estimated minimum savings are based on a comparison with the national average. Individual results may vary, and the estimated savings are not guaranteed. Bundle Select Inc. is a licensed real estate broker. California Bureau of Real Estate Broker license number 004666902.
Welcome back to Real Estate Radio Live. For more information on today's topic or guests, just visit RERadiolive.com. That's RERadiolive.com. Again, your host for today's edition of Real Estate Radio Live, Joe Kuchera.
Welcome back in. Joe Kuchera with Real Estate Radio Live. Thank you for those that are continuing to follow us on Facebook, and thank you for those that download the podcast. We have thousands and thousands of people each month that download the podcast, and I never want to go too long, or every once in a while I just want to remind everyone how much we appreciate the fact that you follow the show, you see value in it. You'll hear me say this all the time because I'm committed to it, and I really am serious about. One of the things years ago when I always thought about I'd love to do a radio show or podcast, one of the things, Steve, that always came to me is, I wanted to make sure that I had valuable information to share with consumers on a regular basis. I just didn't want to get on the show, the radio and podcasts and say, today's a great day and the stock market's up 20% and your home's probably worth this, and, we had 10% sales increase. I mean, you could read the newspaper and get that. Little statistics are good, don't get me wrong, but my focus has always been practical education information, guests like yourselves, content information that people could really feel like, wow, I didn't know that, or I learned that, and that's something I didn't know, and that's something I could pass on to my friend or my family member. Something that, we're actually sharing expertise and information to pass that on, and that's always been the goal.
One of the things when we got involved with this back in 2013, and these products have been around since 2005.
Okay.
Now, in the commercial world, you're familiar with, and most people are familiar with, tenant in common
yes.
investing. That doesn't really work when you're a homeowner. You
right.
really don't want a tenant. You think of it, it's your home.
Right.
It's your castle. So these products have developed into agreements or options that can build in flexibility. And it's with that innovation that also requires great explanation.
Mm-hmm.
So we always need to work with homeowners.
Right.
We need to work with those homeowners and their heirs. We need to work with the CPAs, accountants, estate
mm-hmm.
planners. Because when you look through the problems or the challenges that homeowners have,
mm-hmm.
when a homeowner comes into a financial planner or anyone that deals with finances, they
right.
basically say, what do you have in stocks, bonds? Okay,
yeah.
and then the house is actually put to the side.
Mm-hmm.
Yet it's really the largest investment, but it's because of that illiquidity.
Right.
So by bringing this equity share, I call it a shared economy
mm-hmm.
play, you basically, as a homeowner, are now able to monetize an illiquid or idle asset.
Right.
And most people are pretty happy with the equity that they have
mm-hmm.
built up, especially in the last 6
yeah,
or 7
right.
years. Now, going forward, they're not minding sharing some of that growth, but they do want to keep and protect the equity that they have. So they might not want to go into something like a reverse mortgage that could potentially negatively amortize, meaning that from day one on a reverse mortgage, the loan will grow and it will compound.
Right.
In this, you're able to match a liability so that this liability in the future, you're not going to owe back more unless the home actually increases in value.
Right. Very good. For more information on this, we'll do it during the show. Obviously, if you need to contact me, reradiolive.com, you know how to reach me, call me, email. But for purposes of the Home Wealth Series, just go to bundleselect.com, and go to the contact form. Just give us some simple information. All we really want to do, or you should want to do, is contact Steve or Mark. You get on the phone with them or meet them in person, and then they just really start building a profile, ask you questions, what works, and see if it's something that makes sense for you. And that's as simple as that. And, of course, you can go to our website, contact me anyway, and I'll pass that information on to you guys as well. Again, bundleselect.com. That's bundleselect.com. Just go to the contact page and share some information. Let us know that you're interested in the Home Wealth Program or the series that we're doing, and we could reach out to you. One of the other exercises I like, Steve, is just to kind of go through all the different things people could use these funds from their home with no monthly payments. So if we could just kind of go through all the different things. There's a lot, right? I mean, It's not restrictive, so you don't have to be 62 like a reverse mortgage.
Correct.
18 or over.
18 or over, have to own a home. It'll work with single-family residents predominantly, but it will also work on townhomes, condominiums. And there are even some programs coming up that will allow, rentals. And so every few months or so, there's different features and functions. But the most common uses, number one, is credit repair. A lot of people rack up credit card debt because the house is illiquid. So it's like, well, have the house pay off the credit card debt. The second is student loans, which is you just fall on the credit repair. Or they might want to retire. A HELOC's resetting, recasting,
there you go.
Wipe out that debt. The other side is the parts that are exciting parts is launching business, right? So you could fund a business. That business is probably going to do better. If it's successful, it's going to do better than maybe your house would grow. Estate planning. The house is part of the estate. Many people don't either have enough life insurance or annuity or savings. So what they're able to do is access a large chunk of cash and make up for lost ground on, savings and things like that. And since the home's part of the estate, the home can actually now, you can get that diversification and stability. And then you have what I call, there's different series that we're working on. One of them is staying in style. A lot of people have deferred maintenance on their home, or they want to put an accessory dwelling unit to generate income. They might want to put it out for Airbnb, have a loved one or a relative move in. Maybe move in and then move out, but those are sort of the spectrum.
Reinvest right back into the asset that you got that equity to begin with. And just real quickly on the accessory dwelling units, we've talked about that before. I think it's worthy of reminding everyone. A lot of the counties, I know San Jose, Santa Clara, and I can't speak to a lot, but a lot of them now are advocating building these accessory dwelling units on your property. And there's some guidelines around it, but I could tell you they're relaxed, only because I'm going through it myself right now. And the reason why that's important is this window is open right now to do this. And as Steve mentioned, it's great for additional cash flow, maybe a rental property or maybe family members, aging parents, grandparents. But the other thing that's changing, and I'm witnessing it too, is a lot of what's happening now, too, our children are coming back. They call them the boomerang children, right? You get them out and they're right back. And so, let's face it, this is a reality. It's not that easy for the younger generation, even when they get out of college, to go out and afford to buy a home. And so I tell you, I just had a client a couple of months ago. She emailed me with pictures and stuff. She was so excited. She did one of these conversions. Now what she's doing, she's living in it herself, the conversion.
And renting out the house.
And no, her daughter and son-in-law moved in because they really couldn't afford, and she wanted to be with them. And Well, I guess my point is all kinds of different reasons you could access this capital.
We're teaming up with a couple of ADU specialists that, because this product marries so well.
Yeah.
So there are really three sort of types of ADUs that we're seeing this is used for. One's maybe junior ADU, where you have a separate entrance and is added on to the house. The next is an add-on, right, where you have maybe an entire wing.
Yeah.
And then the third, which I think is what you're talking about,
Detached.
is a full-on standalone.
Right.
So that's a full-blown construction. Now you have a homeowner that wants to have this, but they do have challenges of you have to get the permits, so we're basically teaming up with experts and marrying a home price movement agreement so that the home actually can build this. And it can be a project that can be run on budget, okay?
Yeah.
Because most homeowners, they know what the end game is, but they don't really know the steps to go through.
But one other kind of comment related to the accessory dwelling units, and then we'll move along. But this is not a science, and there's no guarantee here what I'm about to say, but it is pretty exciting when you think about the numbers, and this is the good part. So in a lot of places around here, Santa Clara County, like where I live, Willow Glen, recently is about $1,000 a square foot, right? Mm. So when you do that math, seriously, do the math. If you add 400 or 500 square feet permitted, by the way, is the key word, permitted square feet onto your property, just do the math. All of a sudden, you've got, again, in this example, if your area is going for about $1,000 a square foot, you've just added potentially $400,000 to $500,000 in additional equity to your property. Think about that. Now, again, every situation's different, dollar for dollar, all that. I'm just giving you an example of why this is a great investment, and on top of that, you could potentially access money that you don't have any monthly payments on.
Right. Yeah, so if you look at the square footage building cost, you can put whatever. You might have 300, 400.
Yeah.
And so a lot of times people will look at this and say, wait a minute, it's going to cost me $250,000.
Right.
Well, yeah, but the end game is it's going to be worth $400 or $500.
That's right.
So then the next question is, okay, where is this money going to come from?
Yeah.
And so what you're doing is, as I said earlier, is you're actually accessing the wealth in your home that's illiquid and concentrated, and then you're developing it. And actually, the most of the value in your home is actually the land that it sits on.
That's true.
So you're actually able to develop a resource, and you're just building.
Right.
It's really a threefer. You're able to access it without coming out of pocket. You're increasing the value, and then the last is, if you want to, you can increase your cash flow.
Yeah.
So it's a bit of a no-brainer. It does take work, and you do need to work with professionals. These things it doesn't just happen as easy as you think it would. But if you're teamed with the right folks, they have prefab ADUs now that are They have simple layout plans, so you can stay on budget, and you pretty much get everything.
So they actually kind of build them off-site, right, and then bring them on. And
They do, but you got to have a site permit. And you have to work with the county. And so you have to have someone that speaks countyese, that speaks to the building department. But once you get your ducks in a row, these are very attractive. And I agree with you. Now's the time. Right?
Yeah.
This is it's solving a housing problem.
Yeah.
So they're lax and more lenient now than they've been in the past.
Yeah.
So it's good.
It's really good. Before we cut out, too, the one thing I want to mention we haven't yet is I know there's a lot of real estate agents that follow the show. And thank you, by the way. I get a lot of great comments and feedback from you as well in our industry in general. So if you're a real estate agent listening to this, I don't want to let this skip by you. I'll let Steve speak to it to a minute. But my opinion, remember, when you have these clients that come to you and they're scratching their head, they're thinking, gosh, I'm thinking about selling. I'm not really sure what I want to do. Or, I know there's tax implication. There's a lot of stuff around it. My point is, if you've been in the real estate business for a while, you guys, a lot of you have hundreds of clients that probably come to you or they're trying to figure out what options they have, okay? And the option is not always just to buy or sell. I mean, Steve and I are talking about this program, buy, sell, or stay, right? We all have these options. You either buy, sell, or stay. If you're staying, this is an option. So the reason I wanted to just throw it out to real estate agents, they have hundreds of clients, sometimes less, sometimes more. This is just another valuable conversation they could have with them.
It adds value. The most successful realtors are members of the community, and they're a center of influence.
Yes.
And so they're usually there they create goodwill in the community by being a resource. This is a product or a tool that can be used as a resource. And some people may say, I'm not ready to move, but I'm probably going to be ready in 3 or 4 years. In the meantime, I'd like to do these things, right? So if a certain percentage is buying and a certain percentage is selling, most of them are staying. So now you have a reason to communicate with them and add value where appropriate. So.
Before we cut out, any last thoughts about specifically the topic? Any quick review you want to do again for clients?
Yeah, I would say that over the last 3 or 4 years since we've been doing this, the market has gone up and up and up. And these products, some of these have caps, so that if the house goes up higher, then you're capped out of how much you can share. But now that the market appears to be, and I'm not saying I'm calling a market topic, but this Kay Shiller, getting back to this number, this is the first time in 7 years that it's really gone down, and that's a 2-month lag. So if people are looking at how much wealth, this is well beyond what is normal for California. This might not be a bad time to take a few chips off the table or just diversify. That would be my last... I agree. And I think what I'll say as we close out, for those that are following the show for the last couple of years, I've been ringing the bell and kind of pounding the desk going, do something with those home equity lines because rates are going up. Just last week, 2 other phone calls. I'm helping clients get out of the consolidating. We all know what the challenge is, right? So you have this 3.5% interest rate on your first, and then you need money for some reason. So you take $100,000 or $200,000 on an equity line, and now it's 6, 7, 8% in the next year or so, and it just keeps going up, and it's interest only, so it's really a false payment, and there's no chance of paying it off or paying it down unless you address that at that high interest rate. I would say right now in an interest rate environment, if you could follow this, and I'm serious about it, in an interest rate environment where the interest rates are going up and they're probably going to continue over the next year or so, this product is better than a home equity line. If you're out there and you're thinking about a remodel, an add-on, an ADU, paying off debt, whatever, and you're thinking about accessing a home equity line, seriously, and you guys know me, I've been doing this a long time, this is something you really need to consider. Rates going up, why would you touch that first loan at 3% or 3.5%? And I know some people have 15-year fixes, they're in the 2s. Right.
Why would you mess with that and then access more capital at those rates when this could be an option for you? It really, seriously.
It's just a diversifier. If you were in investments, you would never have that much of your money tied into even one stock or investment. But it's a forced savings plan it's the conundrum, that the homeowners.
All right, Steve, thanks. Good show again.
Great. Thanks,
we'll be back with you next Monday. Again, every single Monday right around 11 o'clock Pacific Standard Time. It is the Home Wealth Series with Joe Kuchera with Real Estate Radio Live. Thanks again for tuning in. Thanks for those that are following us on Facebook. Until next time, have a great afternoon. Take care.
You've been listening to Real Estate Radio Live. For more information on today's program, visit RERadiolive.com. That's RERadiolive.com. Subscribe to our podcast. Discover more at RERadiolive.com.